So we looked at what happens whenever you're using a held to maturity security classification. With the held to maturity, we do not record any interim price fluctuations in the investment that we're attempting to account for. Under trading securities and available for sale securities, this will not be the case. Since they are more readily tradable, or the intent is that they may be traded in trading securities, it is a actual intent to trade based on short-term profits that they can make in trading the portfolio of securities. But in the case of available for sale securities, they are still going to be potentially sold. And so in this case, we use a balance sheet treatment that records the fair value of trading securities that are classified as such, because the fair value becomes the most relevant measure of value. It's relevant because we intend to sell them, and this is the price at which we could sell them. Because we report them at fair value, that means that we're going to be pushing the value of these securities up and down as the market fluctuates. With that reassessment of the underlying value of the asset, we will then have an income statement effect. We will have both realized and unrealized gains or losses reported in net income, again, because of a situation of relevance. The intent to sell makes this idea of market price relevant to the gains or losses. Intent to sell makes that very, very relevant to investors and potential shareholders. We're also going to report the interest received in net income. Remember that this is still a debt instrument. Even though we are intended on selling it for a short-term change in price, we are still receiving interest revenue. In terms of the statement of cash flow effects, because we have an offset between cash payments of interest and the recognition of interest revenue, these two amounts will not coincide, creating the differential, which is the amortization of a discounted premium. And this is going to be true, again, for all classifications of security if it is a debt investment, because rarely are debt investments issued at face value. So we're going to have that adjustment. When they're sold, they actually represent cash inflows from operating activities. When they are purchased, they represent outflows from operating activities. And again, this will be a little counterintuitive. Essentially, you might think that they should be investing activities because we are selling an investment. The only intuition I can give you behind this is the FASB considered that since these are bought expressly with the consideration of selling them for enhanced profit, they should be classified as an operating activity, again, because of this intent to sell. Unrealized holding gains and losses are going to flow through net income, and they're going to have to be reversed to avoid the double counting when it's sold in the future. So for example, when we mark these to market, it's going to involve a adjunct asset account that we'll talk about in a bit, and then a gain or a loss. And then in this case, a gain because I debited it, so I need a credit. Well, this has a net income effect, but no cash effect. And so that just becomes one of those effects that we have to back out of the cash flow from operating activities in order for it to come out as the appropriate cash flow that we're looking for. Okay, so that's a summary of their effects. I'll detail them along as we work through this. We have the same example of Chris investing in Strauss. So Chris would enter the same exact journal entry. Notice the only thing that's changed here is the designation trading securities from held to maturity, but the amounts do not change. It's still, the cash is going to be paid for the present value of future cash flows. So all of the payments that they're promised. And then we record a discount account under US GAAP. In order to get the receipt of interest at year end, again, nothing new and very similar, just symmetrically flipped for an investment than it was for debt. We have interest revenue being recorded. Interest revenue is still at the carrying value times the market rate, the effective interest method, which gives us the amount of interest revenue we would record. The cash payment is simply the PMT, which of course is the stated rate, times the face value, and then the discount is our plug account. right? This entry should be supremely familiar to you by now. You've seen it many different ways, and with interest expense as well. So at year end, this is when the new accounting comes in from what we saw with a held to maturity security. I'd say, assuming that the market rate of interest moves to 9%, and that sets the new price of these bonds at $1,016,199. Remember, this is the market price, which is very distinct from the carrying value of the bond. Remember, the carrying value is based on that historic market rate when we purchased it, right? Whatever the market rate was at that date of purchase, we use that to account for the effects of these bonds over time. The market rate will vacillate wildly as we hold these investments, and that doesn't change our accounting, but it will set a market price, which is very important for both available for sale and trading securities. So we apply the mark to market. We want to adjust the book value of the security. And remember, this book value of our security is going to be whatever the face value of it is, plus or minus whatever is left of the discounted premium. We're going to use another adjunct account, as I alluded to on the prior page, called the Securities Fair Value Adjustment Account. And it is an adjunct account. It's an adjunct account to investments. So it'll increase or decrease the value of my investments account. And then also remember, we have to make sure that our carrying value or our book value is at 12/31/16. We have to record that receipt of interest and the amortization of what we took off the discount. So the carrying value at 12/31/16 would be essentially what we recorded it at, 981.46. That was the issue. Then we amortized $3,105 of the discount, so that increases the carrying value then to $984,151. The market value at that date is going to be set by whatever the market rate of interest sets it to. So it's $1,016,199. The difference between these is what we want to create, because if we don't adjust it, it's going to be at this value on our books. Because it's a trading security, we want it to be this value. And so we're going to adjust it by the difference between those two numbers, which is $32,048. Once we have that information, we can make the entry. So remember, we're talking about a new account, a security fair value adjustment account. And typically, you're just going to have one for all your trading securities, one for all your available for sale securities. In this case, we'll assume that it started at 0, and now we need a $32,048 balance. We want it to be a credit balance because we're trying to take the carrying value from where it is up to $1,016,199. Because we want to increase the carrying value, this has to be a debit, because remember, since this is an adjunct asset account, debits increase it, credit balances decrease it. So we need a debit balance. We want that debit balance, so in order to get it, we're going to have to make a journal entry. We make the journal entry as follows. We debit security fair value adjustment by $32,048, and we will credit what we call an unrealized holding gain. It is just like it sounds. We haven't recognized it yet because we haven't sold it, hence we're still holding it, but it's still a gain. So this entry would then input a debit adjustment in order to get to our overall total. Remember, because this is a trading security, this unrealized holding gain will go to net income. So we want to consider that when we're filling out this table below. The income statement effects for 2016 will begin with the interest that we recorded, of course, $981,105. I'm sorry, $98,105. The way I said it made me doubt how to write it. And then we're going to add to that the $32,048 from that mark-to-market effect. We're going to include it because it's a trading security. And so that makes the overall net income effect $130,153. Now, there is no OCI effect, but whenever I ask for an income statement effect in general, it's good to notate whether it's a net income effect or if it's an OCI effect, because technically both could be on the income statement. The balance sheet valuation is going to be $1,016,199. Remember, we want the balance sheet to be at the market value of the investment because, again, it's a trading security. The statement of cash flow impacts. Now, there's a few for trading securities. The first one, the primary one, if you will, would be an effect to our cash flow from operating activities. It would have resulted from the purchase of this investment, which would be a $981,046 outflow for purchase. That represents the purchase of this investment. Remember, because it's a trading security, it goes to the operating section, even though you might think it's going to the investing activities. The next item we want to adjust for would be the mark-to-market effect. We adjust for this effect because notice this unrealized holding gain does flow to net income. Hence, it does have an earnings effect, but it does not have a cash effect because we haven't sold it yet. And so in this case, net income will contain a $32,000 revenue, or in this case, a gain that we haven't recognized as cash. So we need to subtract that out. This is a negative $32,048 adjustment to net income to derive CFO. And again, notice I'm very careful about my language because while the purchase of the security represented an actual outflow of cash, this is an adjustment. It's not an outflow of cash, right? And then finally, we have another effect to the CFO because of the recognition of interest revenue being distinct from the amount of cash paid. We would have to subtract any amount that we amortize from the discount. $3,105 of the discount. Right. So those are the effects on the financial statements of trading securities. A little more complex in some ways than HTM. Available for sale securities are the gray area securities. Because of that, we're going to push them toward a more relevant and fair market value. We want to recognize their gains and losses in some way, but we don't necessarily want to do it to the extent that we have done so for trading securities. So we reach a bit of a compromise in the accounting for these items. When we purchase the available for sale security, it's reported at the present value of the future cash flows like the others, and we're going to want to report them at fair value. Again, because of the idea that since these are possibly going to be settled, their fair value represents something of interest to investors. It's going to require a year-end adjusting entry, again, because we want to push the value of the asset up or down. We're going to have to do that with a journal entry. And when we debit the value of the asset, that is when its value increases, we'll credit a gain. And if we have to credit the value of the asset when its value decreases, we'll debit a loss, right? The income statement treatment. Well, first, again, we have interest revenue using the interest rate method. That's going to affect net income. When we have a realized gain or loss, we're going to report that and record that in net income. We want to make sure to only do that if it has been sold, if it's been sold, right? So when they're sold, we do record the gain or loss in net income. However, if we have an loss from, just a second, I'm having a little bit of technical difficulty. If we have an unrealized gain or loss that accrues from the price fluctuation prior to sale, that's that unrealized gain or loss. In this case, we're going to want to put that into OCI. Right? And as an OCI account, it will not affect net income. Okay? The statement of cash flow treatments, when we have, again, that difference between the interest revenue that's recorded and the cash amount paid, we'll have a difference that will amortize at premium or discount. And so you do need to keep in mind that adjustment. When they are bought or when they're sold, we have to record an investment or an inflow or an outflow to the investing activity section. So this follows your intuition. Hey, I'm putting my money into an investment. That's an outflow. Or I'm selling the security. That would be an inflow of an investment. And then the difference between AFS and trading securities is that because their unrealized gains or losses flow through OCI, there's no need to adjust net income. Remember, when we are making that adjustment from net income to CFO, we're wanting to get rid of anything that's in net income that wouldn't be a cash flow. Well, if you remember, and we're going to go over it a bit, the structure of the income statement, these unrealized gains or losses, because they are OCI, they would actually flow into OCI, so they don't enter into the net income picture. We're using a number, net income, that occurs before the inclusion of these, and so there is no need to back them out of anything. Right? Other than that, once again, the same entry for purchase, recorded at the present value of future cash flows. And then that first interest payment is going to be recorded just the same. We will have the effective interest rate method used, it's carrying value times the market rate. And then we get to the mark-to-market effects. The carrying value, because we make the same interest revenue recognition, it will have the same carrying value. And then the market value at that date, $953,463, would be what we want to adjust it to. That's what we want to report it at, because again, we're reporting these at fair value. This would create a desired balance of $30,688. That desired balance is going to be recorded as a security fair value adjustment account like we used prior, except that this one will be for the AFS securities so that we don't cross paths and make an adjustment to the trading securities account. Now, the difference here is that since the carrying value is above the market value, we're wanting to bring it down, so we're wanting to decrease it. And remember, since this is an adjunct asset account, we're starting at zero, but we'll want a $30,688 balance in order to appropriately reflect the fact that we want to decrease the value of this security. So when you're journalizing this, you're going to debit the security fair value adjustment account by $30,688. That will put the appropriate credit adjustment into the T account. And then we're going to want to debit an unrealized holding loss. Right. So it makes the appropriate loss. We wanted the securities value to decrease. Well, that would represent a loss, a credit to the security fair value adjustment account. And so now, again, we want to record the effects of the security. We would still have the $998,105 of net income from the interest revenue. But now this $30,688,000 loss is going to go to OCI. The balance sheet will be whatever the market value is at that date. And the statement of cash flows will represent the fact that we purchased a security for $981,046, cash outflow. And then we would have to worry about the discount that we amortized. Remember, that was a $3,105 discount. Remember, we don't have to make any adjustment for the mark-to-market effect because this went to OCI rather than to net income, right? Because it went to OCI, there's no need to adjust net income for that effect in order to derive cash flow from operating activities. Oops, and I should have that. Never mind. Cool. Now we need to record the second payment of interest. The second payment of interest would just be based on the carrying value of the security. That's still in the books. Notice that this is still the carrying value of the security, right? It's always going to be the face value minus the discount. Just because we altered the balance sheet value, that doesn't mean we changed this carrying value. We're multiplying it by the market rate to get the amount of interest revenue we'd want to record, $98,415. We make the journal entry. The cash coupon payment is $95. Interest revenue is $98,415. And then the amount of discount that I want to amortize would be $3,415. By amortizing that amount, I bring my carrying value from $984,151, which it was at the beginning of the year. Since I reduced the discount, it would then be $987,566 at the end of the year. That's its book value, or that's its carrying value, right? Its carrying value at that date, $987,566. But we don't want that value. We want whatever its market value is, which is $981,430. The difference between these two guys would indicate a reduction of $6,136. Now, again, we're trying to mark it down, so this would be a credit balance that we want in that account. So looking at the fair value adjustment account now, remember, we already had a balance in the prior year of $30,688, and this is a real account. So we will have rolling balances in this account. We want a $6,136 credit balance. So now we have to make an adjustment. We make an adjustment by saying we need a debit amount here of $24,552. And that tells me I need to make a journal entry. So I'll journalize the security fair value adjustment account, $24,552. And it's an unrealized holding gain. Now, remember, even though we're still at an overall loss position, we're at less of a loss than we were before. Okay, so we have an overall loss, but we still have a gain for the period. The income statement effects would be the amount of interest revenue I recorded. That will go to net income. I would have a $24,552 OCI gain, but those are going to different subtotals. The balance sheet valuation will be what the market value was on that date. As remember, now this is just a confluence of three T accounts. The investment T account, which is always at face, on the other side, at face value. The discount account, and the security fair value adjustment account. So the balance sheet value is made up of the algebraic sum of all three of those various accounts. And then finally, for the statement of cash flow effects here, because this is an OCI effect, we don't report it in as an adjustment to the cash flow from operating activities. We do have to still remember to adjust for the amount of discount that was amortized. And we're going to want to make that as an adjustment to net income to derive CFO. Okay. At this point, to practice what we just looked over, I would suggest you working these different examples from the case notes that I give you, the problem sets I give you for this module. And I will pick up in the next video with a short explanation of what we do when we sell securities.